UTI Flexi-Cap, the flagship scheme of UTI Mutual Fund, having asset under management of 25,318 crore, has underperformed in recent times. In this interview with Business Standard, Mr. Ajay Tyagi, head of equities at UTI Mutual Fund, explains the reasons for the fund's underperformance and why he remains optimistic about a turnaround soon. He also explains why it is important for a fund manager to adhere to his investment style, in his case, the quality growth style, even when the market goes against you. Do watch this interview to learn more. Good afternoon, Mr. Tyagi, and welcome to our show.
Good afternoon, Sanjay. Thanks for having me here.
We are speaking at a very interesting juncture in the equity markets. 2022 was kind of marred by the Russia-Ukraine war, and then we had global inflation, and then the central banks came down hard with very fast-paced and frequent interest rate hikes. But this year seems to be much better. The indices are up. The central banks also seem to have much better control over inflation. Both the US Fed and the RBI are in pause mode, though the risks haven't gone away completely. In your view, what impact will this altered inflation interest rate dynamic have on the equity markets in FY24?
Yeah, that's a very important question, Sanjay, especially in the context of what's been happening in the last 1.5 years. And just to give you a very quick, I would say, backdrop to what happened, you see, we went into an inflation trajectory which has never been seen before in the last 40 years. India was still fine, but the Western world went through an extended bout of inflation, like I said, not ever seen after the 1970s. In response to that, to cool off inflation in a way to kill demand, central banks around the world had to increase interest rates, and that too in an unprecedented manner. We haven't seen this again after the 1970s. We all know that higher interest rates are always bad for equity markets. As cost of capital increases, the value of equities as an asset class comes down. So the whole of 2022 was just trying to adjust to what eventually the interest rates would be, how far can they go, how deep can inflation be, and therefore, as a consequence, what could be the overall damage to equities as an asset class. I think somewhere in the last 3 or 4 months, we've reached to a situation where I would say there is now visibility of terminal rate, as we call it, which means we know that the Fed rate hike would possibly end another 25 basis, at max 50 basis from here. And actually, that's good news for equity markets because they now really know that what has been the total extent of damage rather than being totally uncertain about this. At some stage, and difficult to say when, interest rates will also start to reverse, possibly sometime in 2024, maybe early 2024.
So which sectors are you positive on for FY24?
So I think there have been a few sectors which have been beaten very badly in the last 1 year. And I would say the longer term prospects for these sectors still look as strong as they ever were. And these sectors are some of the domestic consumption facing sectors like consumer services, consumer durables. And these sectors, of course, did see a sharp correction in terms of valuations. Equally, hardening commodity prices were negative for many companies in this sector. So therefore, margins of these companies got impacted. I would say we should ideally see a reversal of both of these things. As interest rates start to come down, we would see valuations actually, or P multiples as we call them, starting to reverse for many of these consumption-oriented sectors. At the same time, margins have already started to move up with commodity prices falling. And I think margins will continue to move up in the coming quarters as well. Last but not the least, see, high inflation is also bad for consumption because as disposable income comes down on account of inflation and consumer surplus goes down, discretionary spend actually softens. I think with inflation cooling off in India as well, we would see better consumption trends in the coming year. So I think consumption clearly is one sector. A very similar story is for the healthcare sector. Here, the margins of companies got badly hit because of increasing prices of inputs on account of very high chemical prices around the world. So that led to margins of many companies, or majority companies in the healthcare sector suffering. I think that will also reverse. Last, I would say private sector banks in general, which haven't really participated as much in the markets over the last 1 to 2 years. But again, they remain very solid franchises, very solidly managed. India's credit penetration is still very, very low. So financialization, as we call it, is still a multi-decade theme. So I think private sector banks would be the other one where I would remain bullish. Yeah.
Which sectors are you negative on?
See, I would be negative on anything which is linked to the global demand supply. So we all know that global demand is going to soften in the coming quarters, in the coming years, because maybe US is able to skirt a recession. But the fact is that demand trends in the US, even if recession or a deep recession doesn't happen, demand trends in US will remain weak. Demand in Europe is weak. There was a lot of hope on China reopening. That hasn't played out as many would have expected. So China too is going to see a softer demand trend. So this is bad for commodities globally. This is bad for energy globally. So anything which basically has a negative impact from global demand would be sectors where I would say we should be bearish.
And what are your views on IT?
Sanjay, we are very positive on IT. All I can say is that I would want to believe, and there is data around us to make us believe that what we are going through right now is a bit of, what one would like to call as the technology age. Just like we had the Stone Age and the Iron Age and the Bronze Age and so on, we are living in a technology age. And I think this technology age started sometime during the 70s and 80s. Technology is embracing our lives like never before. We can't do anything without technology, including this call that we are doing today. So I think technology is going to be the driver of multiple businesses and multiple industries around the world. It used to be a cost saving tool till about 20, 30 years back. It is no more so. Technology is an important tool to now gain market share and be relevant in front of customers. So IT services companies, which are basically implementers of these technologies, while they are never the innovators of technology, but they are the implementers of all new technologies, even including generative AI that we keep talking about. You see, these companies will continue benefiting over the coming years, and I would perhaps say over the coming decade. So longer term picture, very, very positive. Yes, they will go through their own cyclicals, ups and downs. Possibly people are negative on IT today on account of the impending US recession. But if you look through all of that, the big picture is still very solid. Yeah.
What is your approach to investing? Do you fall in the value camp, the growth camp, growth at reasonable price, momentum, quality? How would you classify yourself? And what is your approach to stock picking?
I think that's an excellent question, Sanjay. Thanks for asking that question. I think my approach to investing would qualify as quality growth. First of all, let me say that we have different styles within UTI. We take great pride in the fact that we are a very diversified asset manager with very different styles being supported by our research team. But each one has a very different approach and style. In my own case, we call it the quality growth style. It is obviously starting with quality first. So we don't want to chase companies which have very strong growth outlook, but they are not able to actually back it up with high return on capital, high cash flow generation. And as a result, while chasing that growth, they end up having weak balance sheets. We want to see evidence of quality. And let me define quality for you. Quality, simply put, is nothing but high return on capital, strong cash flow generation, as a result of which balance sheets always remain strong with low to no debt. In fact, in majority of the cases, the balance sheets have strong cash position rather than debt position. So that's the, I would say, definition of quality which we like to follow. We want businesses to actually be self-sustaining in a way in order to chase growth. Once we've solved for quality, Then we go to the next step, which is growth. Then we try to find out that, look, now that this company has a business model which is extremely resilient, which is anti-fragile, which can take care of itself, which is not dependent on external sources of funding, which will remain strong even if the economic cycle goes down, let's then start to look at business models which will have a multi-year, multi-decade growth in front of them. So in a way, why we call it quality growth is because we want to look at both attributes, and the fund is constructed at the intersection of quality and growth. We want both attributes. So yeah, so that in short is our core philosophy.
And when you apply these filters of quality and growth, stocks from which sectors generally tend to come into your portfolio?
Sure. I would say, at the top, you will find companies from the IT sector. You'll find companies from the consumer sector. And here I would say it will be all across the consumer sector. So it will be consumer services, it will be consumer durables, it will also be consumer staples. Of late, we are seeing less evidence in consumer staples because the growth in the staple sector is actually coming down. I mean, it's no more the growth that one witnessed in the 1990s and the 2000s, simply because the penetration on a lot of these staple categories in the country has gone up. But the durable categories or the discretionary categories are still having a lower penetration. So the overall consumer sector, with now of the last few years, we are seeing a more higher tilt towards discretionary, durables, and services. Then we find within the banking sector, all the private sector banks, or in fact, I did not say all, but majority of the private sector banks fitting this core philosophy. Last but not the least is the healthcare sector. Here again, across formulation companies, diagnostic companies, I would say a lot of these companies which are into exports of pharmaceutical ingredients, intermediates, and so on. So healthcare sector also throws up a lot of these business models which are both high quality, high growth. On the other side, there are sectors where there is no evidence of quality and sustainable growth over the long run. The entire commodity SPAC, the entire oil and gas or energy space, public utilities, aviation, infrastructure and construction. These are the sectors we find it very difficult to find both quality and growth together. Yeah.
Now, the problem with picking up these quality stocks is that they're usually available at very high valuations. How do you tackle this issue, and how much are you willing to pay for such quality stocks?
I think, Sanjay, it's a very important question that you've asked because obviously the pushback really is that we know it's a great business. Is it a great stock? I think the first thing that we have to understand is that in order to really create sustainable wealth, you have to be in the company of great businesses, and you can't compromise on that at all. The second point then is that, okay, it's a great business, but at what price should we be buying it? And here there are no easy answers. Every business will have a fair value. And typically I'm now talking in terms of price earnings multiple because that's the most common metric people use, although that's not the best way to evaluate these companies. But in order to actually just express my views around valuation, let me just stick to this price earnings multiple. You see, the price earnings multiple for a high quality, high growth business will always be higher, and rightfully so, compared to a commoditized business, which has a poor ROC, poor balance sheet, and very cyclical growth profile. And it's not too difficult to understand this because the fact is that if you're buying an asset which for a very, very long period of time will not only keep showing you high quality growth, but those growth rates itself would remain high, then you should be ready to pay a higher multiple of next year earnings, because price earnings multiple is nothing but price that you are paying today on the next year earnings. Now, two different businesses, one which grows maybe at between 5 to 10% and the other which grows between 15 to 20%, may look cheap or expensive on the earnings of tomorrow. But if the business which can keep compounding at 15 to 20% for a very, very long period of time is held during that entirety, then even a high P for next year earnings is actually not as high as it optically looks. The most important thing to check here is, will these earnings be sustained over the next 10 years or not? So I think even when you're saying the argument is that, okay, these are great businesses, but the valuation is very high, I don't want to spend too much of time only on the valuation. I want to spend time on whether these growth rates and these high return on capital and the quality of the balance sheet would be sustained over the next 10 years. If they would be sustained, believe me, even something which trades at 40, 50 times is not all that expensive, because the compounding will take care of what is optically just expensive today. Yeah.
And are you a buy and hold investor, or do you tend to churn your portfolios a lot? What is the typical portfolio turnover ratio in the funds that you manage?
Sure. So our portfolio turnover ratio in the quality growth strategy that we are discussing right now has been between 10 to 15%. So in a way, you can call us, buy and hold for a very long period of time. And we sell only when, either one of these two attributes, either quality or growth, starts to wane down in the business that we have purchased. So like I mentioned in reply to your previous question, we want both. If let's say the business remains high quality, but increasingly we are seeing challenges in terms of growth rate, and possibly growth rates will come down from 14, 15% to let's say only 8, 9%. That's the point where we would say, look, we must exit this business and look for something else, because the compounding from here on could only be about 8 to 10%, almost in line with the underlying growth rates. Or it could be possible that the business never had a very strong moat, or the moat has been weakened because of competition, and therefore there is margin pressure. And because of that margin pressure, the profitability, the return on capital is weakening. That also could be a reason for exit. If both these things are not happening and the businesses that we are holding are indeed continuing to remain high quality and high growth, then yes, we will remain buy and hold forever. Yeah.
Next, we'll talk about the performance of your flagship fund, UTI Flexi-Cap, which is, for the viewers' information, a 25,000 crore plus fund. Now, 2021 was an excellent year for your fund. You were up about 34%. But then in 2022, the fund fell minus 13%, whereas the category average was about 0.16%. So what happened? What are the reasons for this steep underperformance?
Sure. See, we discussed in the first question itself the impact of rising interest rates on the markets in general in 2022. Now, what happens is that when interest rates rise, they impact growth-oriented assets much more than value-oriented assets. And let me just explain this to you. It is a very commonly understood phenomena that as interest rates rise, long duration bonds get impacted more than short duration. So if you are having bonds which are 10 years maturity, the rising interest rates would have a higher price impact on a bond of 10-year maturity compared to a bond of 1-year maturity. And therefore the prices of the 10-year bond will come down more than the price of 1-year bond. That's no reflection on the credit of the credit rating of that bond, that it is only to do with the duration. When we talk about equities, and we typically divide equities into the value camp and the growth camp, what again happens is that growth equities are the ones which will continue showing growth for a long period of time. And value equities are typically the ones where the growth is neither going to be very strong, nor can you extrapolate that growth for a long period of time. Rising interest rates impact growth equities because they are long duration assets. Their growth is expected and their businesses are expected to continue growing for 30, 40, 50 years. Therefore, like a long bond, the impact of rising interest rates is much higher on growth equities compared to value equities, which are in a way short bonds. Now, when interest rates rose and rose unexpectedly to a level where nobody had imagined, the compression in price earnings multiple of all growth oriented equities was very, very high. While their businesses continue to do well, but the adjustment in terms of valuation, price earnings multiple was very, very steep. That has been one of the largest reasons for our underperformance in 2022. Along with that were a few other reasons. As the war broke out in early 2022, commodities went through a rally, energy stocks went through a rally, defense stocks went through a rally, because all governments around the world, India included, just stepped up on the defense budget. These are sectors, like I explained to you earlier, we would never invest in. So we were hurt by not owning anything in these sectors, equally hurt by being bullish on the sectors which are long-term growth oriented, but had to go through a reset because of rising interest rates. Yeah.
Now, for our viewers' benefit, could you explain that when the market goes against your style of investing, does a fund manager like you change your investment style, or do you stick to the investment style that you have been following?
Sanjay, I think this is the best question in the discussion so far. And this goes back to the philosophy of, or rather not the philosophy, this goes back to the core of what makes a great investor. I love to make the statement that successful investing is only 10% finance, 90% behavior. You see, selecting a great stock is not all that difficult. If you go through some amount of training, in a few years, you would know how to select a great stock, how to select a great business. The problem is how to withstand that pressure when things are going against you. And that is where the behavioral aspect of investing is very, very important. What separates great investors or successful investors from not so successful investors is the fact that they have a very strong behavioral trait and they can hold on to their core philosophy during adversity. So I would say that absolutely yes, the endeavor is that to hold on to your style, not to make changes when things are going against you. It is obviously very, very, I would say, I mean, very common for investors to start feeling uncomfortable, start feeling the pressure of underperformance, and therefore start moving away from their core philosophy. But that is, in the long run, extremely injurious to the performance of the portfolio. You just have to stick to it. You have to accept the fact that markets go through cycles. Sometimes a particular style does well, sometimes something doesn't work. But if you just hold on, and you don't have to hold on for 10, 20 years, by the way, you just have to hold on for a couple of years. If you hold on through those couple of year periods, no matter how unnerving they can be, then you surely are on the path of being a successful long-term investor. Yeah.
And this year to date, your fund is up about 5.45%. The category average is about 6.02%. Would you say that you are on the comeback trail?
Sanjay, early days. And I'm the last person to comment on what will happen over the next 6 months or 12 months. Let me be honest, it is impossible for any one of us to ever predict what's going to happen in the next 6 or 12 months. But yes, like I just said in my previous reply to your question, what we are confident about is that if what we are owning are great businesses, and these great businesses have seen a markdown in terms of their valuation because of increasing interest rates, and not as much their business performance, then you will also see a reversal of this sometime in the coming years. Growth will come back, very sharply as a style. Value has been doing well for 2.5 years now. We all have those numbers in front of us. Eventually, while we may not be able to predict whether value will do well or growth will do well, eventually, if you hold on to a business which is creating economic value, but hold on to it patiently through ups and downs, you will end up creating alpha for investors. And that's what our endeavor is. Yes, 2023, starting from the US, not as much in India, has already seen a massive reversal of growth. It's very evident in the way MSCI growth versus MSCI value have behaved over the last 6 months. Yeah, I mean, at some stage, what we've been saying constantly is that this reversal from value to growth will happen. I can't predict when, but our portfolio is waiting for that reversal because we haven't changed it one bit, and therefore we should be able to take a ride whenever it happens.
So the message to investors in UTI Flexi-Cap fund is to just hold on to the fund. Is that it?
I would say so. Our convictions are very, very high. We are tracking the portfolio and the constituents of the portfolio rather than making a judgment on, how the markets will behave. And I think it's very evident, by the way, how we have, kept the same portfolio, not churned it. It just goes to show our conviction on those businesses that we are holding on and how their outcomes, their business outcomes would pan out in the next 3 to 5 years. So I would say, hold on. Patience in this business is always rewarded.
A slightly unrelated question. Year to date, the mid-cap index is up about 10% and the small-cap index is up about 9%. And a lot of retail money is now flowing into small-cap funds. What would your advice to retail investors be about investing in small-cap funds?
Yeah, sure. Sanjay, I would say our research over the very long run shows that small cap will remain, has been, and will remain an extremely volatile corner of the market. And you know, you see massive rallies and massive corrections happening, but there are two things that we need to know. If you just compare the mid cap index to the small cap index over a 5, 10, 15-year period, forget risk adjusted returns. If we just talk about absolute returns, mid cap has done better than small cap. For all the love and affection that and fan following that people have for small caps, the fact remains that the mid cap segment has performed much better than small caps in terms of only returns. When you obviously have risk adjusted returns, then it becomes a no comparison at all. So just looking at this data in front, I would say people should just, I'm not saying don't own any small caps in your portfolio, but please exercise restraint and caution. This is one part of the market which always sounds extremely appealing, and I should dare say adventurous to many investors. But in the fullness of time, the evidence really doesn't show that it gives you extraordinary returns. So I would say continue with the balanced asset allocation. Never swing your portfolio in any one direction, whether it's large caps or mid caps or small caps. Have a balanced approach, stick to it. So just know what's the right kind of allocation you should make to small caps. Please stick to it through ups and downs. Yeah.
Thank you, Mr. Tyagi. It has been a pleasure interacting with you. I have learned a lot about the nuances of managing a quality growth-oriented portfolio. I'm sure our viewers will also benefit immensely from this interaction. Thank you very much and have a good day.
Thank you very much, Sanjay. I enjoyed the discussion as much as you did, and really incisive questions, I must say. Thank you.
Good night.